Hi, I'm Anna Griffin, and I chose to do my thesis research on how blockchain could impact the accounting industry. First off, what is blockchain? Blockchain is a relatively new technology that was originally invented in 2008 to facilitate cryptocurrency trading, specifically Bitcoin. On this slide, I included two definitions of blockchain, and instead of reading them to you, I'm going to discuss the key features of them. What makes a blockchain platform unique is that there is no need for a centralized authority, such as a bank, to allow transactions to be done. Instead, the transactions are approved and validated by a consensus of the users on the blockchain. Blockchain is a shared ledger, which means that everyone on the network can add and see transactions taking place in the same spot instead of all of the users having to update their own separate ledgers. And for those watching who are not accounting people, a ledger shows the balances in all of an organization's accounts. Blockchain is also a very secure platform as it is highly encrypted. There are a few things I wanted to be sure to point out about blockchain. First, as I mentioned on the previous slide, transactions are approved by a consensus of the users. This consensus is typically reached by a majority of users, but sometimes all of the users must agree for a transaction to be verified. Second, once transactions are approved to be on the blockchain, they are immutable, which means they cannot be changed. And lastly, while blockchain was originally invented to help with trading cryptocurrencies, this technology is applicable to many different types of industries, which we will go into later. Here is an example of a blockchain that includes some technical details on how it works. The most basic thing to understand is that a blockchain is made up of individual blocks that each contain transactions. And on each block of transactions are three pieces of specific identifying information for that block: two hash values and a Merkle tree root, which I will now explain. Each block contains its own hash value, which contains the timestamp of the block, the difficulty level of the block, and the naught, which is a random number to help verify the specific hash. Each block also has the hash value of the previous block on it, as this allows the blocks to be linked together to form a chain. Lastly, the Merkle tree root is included, and this is a complex math calculation that summarizes the transactions in the blocks. As we said earlier, transactions cannot be changed once they're added to the blockchain, and this is why. Because the hash values would be different, as well as the Merkle tree roots would need to change, and that is not allowed. There are different types of blockchains out there for companies to choose as to which would best serve their purposes. The first type is a public blockchain, and anyone can join this blockchain, and it is completely anonymous, transparent, and decentralized. The second type is a private blockchain that an organization sets up and invites different users to join the network. The organization can also grant different levels of access to different users as to what they are able to see on the blockchain. Accountants are more likely to opt to use a private blockchain over a public one, so they can know who is allowed to be on the network and submit transactions for approval. They could also limit access to some financial information to only those who need to see it. And the last two types of blockchains are a consortium and semi-private blockchain. Now we are going to discuss overall general benefits blockchain provides. And these benefits can be grouped into three broad categories of secure transactions, decentralization of transactions, and quicker transactions. For secure transactions, we have already talked about the immutable nature of transactions and how hash IDs and Merkle tree roots prevent people from tampering with what has already been recorded. The immutable characteristic of blockchain also allows there to be an audit trail of the transactions. So if there is a question about something, the money or asset can be traced back through the network. The transparent nature of blockchain makes sure nothing can happen shadily and increases trust among users. Security is also enhanced on blockchains due to users having anonymous addresses, and they are encouraged to change them often. And no blockchain has been hacked yet due to the high security. Something that makes a successful hack extremely unlikely is the decentralized nature of blockchain due to everyone having a copy of the ledger on their computer. In addition, privacy for transactions are increased because there's not a third party to also see the transaction. Also, as users have to validate the transactions themselves, this takes the governing authority of the transactions and makes it available to all of the users instead of just having one organization or person in charge. The third overall benefit blockchain provides is that it is fast. It operates in real time, documenting transactions. I mentioned the audit trail blockchain provides, so this reduces the time needed to do bank reconciliations as the transactions have already been approved and all the users have a current copy of the blockchain ledger. Quicker transactions also make it easier to engage in business around the world. Another beneficial aspect of blockchain are its smart contracts. Smart contracts are self-executing contracts, which means that the terms are put into the contract, and when the parties fulfill their end of the deal, the contract completes automatically. As we've discussed the overall benefits of blockchain, now we will look at the general concerns the technology poses. These concerns include a current lack of understanding about the technology. Blockchain is complex, and it is hard for people to wrap their head around how blockchain works or exactly what it does, which makes them more hesitant to use it. If a business decides to implement blockchain, they will face high startup costs for the platform, and blockchain can be difficult to integrate with current business processes. Blockchain also requires a lot of computing power for the complex math verifications to be performed, so businesses will need to be sure they have the energy infrastructure in place to handle the energy needs. Another concern lies with who will regulate blockchain, who will make changes to the blockchain or address any ethical issues that arise due to its decentralized nature. Next, I'm going to give a few examples of how blockchain can be used for non-accounting transactions before we jump into how it could affect accounting. As I mentioned earlier, blockchain's original purpose was in relation to trading cryptocurrencies. Companies with high shipping and transportation needs, such as UPS, FedEx, and Walmart, are using blockchain. Insurance companies could benefit from blockchain by using smart contracts to help people with submitting claims. Once the terms under the insurance contract are met, the insurance company could automatically have money sent to their customers. This could help claims be filed faster and people receive the money they need in a more timely fashion, especially after natural disasters or other widespread times when insurance companies get really busy. The music industry is another industry that is looking into blockchain, and Spotify is currently using it to help distribute royalty payments to musicians. Blockchain could be used to provide secure online voting. With blockchain, votes would be counted in real time, fears of hackers would be minimized, and people could see their vote was sent and received. As a last example, blockchain can assist with real estate transactions, such as buying and selling property or leasing an apartment by utilizing smart contracts. Now, we move into how blockchain can and is being used in accounting. The Big Four accounting firms are all exploring blockchain in various ways. PwC has partnerships with a few organizations to look into providing blockchain services. They've also collaborated to create a blockchain named Vulcan, which is designed to store and trade digital assets. Deloitte has mainly focused on using blockchain to improve supply chain management. They have created a platform named Rubix that was initially created to look into how to better the auditing process of blockchain transactions. EY has actually been looking into creating an editable blockchain through partnering with Accenture. They want to do this so it is more feasible to make corrections if mistakes occur. Lastly, KPMG has partnered with Microsoft to provide digital ledger services to clients to advise and teach them about blockchain. They also created a couple of blockchain nodes, innovation workspace labs, which were labs where people could go experience blockchain simulations to try and understand it better and see how it could affect their company. Overall, the Big Four are developing more employees to focus on blockchain, which shows they feel blockchain has a serious potential as an up-and-coming technology. Now, we will discuss the benefits blockchain can provide to the accounting industry. First, blockchain can minimize fraud risks. Applebaum and Smith say that blockchain reduces the possibility of cutoff and reliability issues, making it harder to cook the books, otherwise known as fraud. Blockchain also reduces the chance of entries being made in error due to the consensus mechanisms requiring multiple users to approve them. The accounting industry also benefits from blockchain operating in real time. For one, there is the ability to create more current financial statements, as they could be created as often as daily instead of creating them periodically. This could give accountants and others higher confidence in decision-making with very current information. Real-time operation also means that accountants can spend less time completing reconciliations. Tax and audit are also positioned for blockchain benefits. From a tax standpoint, blockchain could allow taxes to be recorded automatically instead of having to add them retroactively and pay them in the following year. From an auditing standpoint, continuous auditing is poised to come about. Currently, a sample of transactions have to be taken, as there is no way for an auditor to audit every transaction. But with blockchain, continuous auditing allows every transaction to be audited. Another benefit to accounting comes about based on who can access information. Due to all the users having access to transactions that occur on blockchain and verifying them themselves, this allows accountants to be able to spend less of their time verifying data and more on interpreting it. In addition, accountants could be allowed to have complete access to all of the financial and accounting records, which could increase the trust between the business and the accountant due to them seeing all of the current information. Smart contracts have the potential to provide accounting with many benefits. To start, accounting standards could be written into smart contracts to ensure transactions complied with accounting standards before being made in error and then having to deal with correcting the transactions and paying any resulting fees. Any repetitive accounting activities could be performed automatically to allow accountants to better work on other tasks. Revenue recognitions could be completed, depreciation calculations can be made easily, and smart contracts can help classify assets appropriately. Lastly, smart contracts could be combined with artificial intelligence eventually to measure and automatically record damage that occurs to physical goods. Accountants should not fear, because even with blockchain, they are still needed. However, they may experience a shift in tasks they do if blockchain is implemented. Currently, accountants spend a lot of time organizing data and preparing financial reports, but with blockchain, their role can shift more to being an advisor to their clients. Also, among duties accountants will perform, they will need to be sure to assess the real-world effect of the transactions, because just because a transaction is recorded does not mean the physical exchange occurred in real life. Accountants will have to verify that the blockchain is functioning correctly and acting as they plan for it to, and they also will have to continue working with transactions that may not get shifted over to the blockchain. However, with the benefits blockchain can bring to accounting, there are also concerns. First off, accountants are fearful their job will be automated. And even though I just talked about how accountants will still be needed, some in the profession are nervous as the status quo of their job is changing, and they are not quite sure yet if and how they will be affected. There's also a concern that the blockchain ledger will be incompatible with what users actually own, but that is also a concern with other ledgers currently. There's also a concern with automation of auditing. With blockchain, will auditors be responsible for auditing the entire blockchain or just the transactions on the blockchain? Also, even though chances of fraud are lower with blockchain, this benefit mainly applies to retroactive fraud, changing transactions, as fraud can still occur if it occurs at the start of the transaction and the transaction is approved. The high implementation cost of blockchain can be a concern for businesses. Another concern is if a business does implement blockchain, the versions of blockchain that are first implemented could become obsolete, then it could be expensive and cumbersome to change blockchain platforms. For moving forward in the accounting industry, I will briefly mention just a few considerations that need to be taken into account. The first issue to consider is the governance of blockchain as to who will set guidelines and standards for the industry. According to Singer in 2018, a possibility of an organization that may do this is the Accounting Blockchain Coalition. Another issue is who would have access to information on the blockchain and what information should be kept on it. Should all users have access to all of the accounting information, and how much accounting data should be kept on the blockchain? An implication of continuous auditing includes the amount of big data that will be generated that accountants will need to figure out how to handle. And across the board, accountants will need to receive education on blockchain so they do not get left behind as the profession evolves. Also, if blockchain does become widespread, businesses will need to have the financial resources and technological capabilities in place to implement it. Lastly, a popular term circulating around in regards to blockchain in accounting is triple entry accounting. This term is misleading because it would cause one to believe that a totally new additional entry would be added to the traditional debit and credit double entry accounting system. However, accountants can rest assured that this triple entry accounting referred to with blockchain is less intimidating than it seems. Instead of adding a totally new entry that would change the established balance of debits equaling credits, this third entry is just meant to cryptographically confirm the normal debit and credit on the blockchain. Instead of having two separate business ledgers, blockchain can serve as one shared ledger for both companies to operate on. In conclusion, for accounting specifically, blockchain provides many benefits and concerns that must be weighed when considering implementation. As more time and energy is devoted to developing the technology, concerns could become less worrisome. Overall, accountants should not be afraid of blockchain's potential widespread entry into the accounting world. Instead, they should try to learn about current experimenting efforts and platforms being tested to see which ones could affect their company or their clients they assist. More time needs to pass before it will be made known how effective or popular blockchain will be in the accounting industry, but accountants should not turn a blind eye to this technology. Accountants must be willing to adapt to this platform if and when the time arises. Thanks for watching, and thanks to Dr. Leonard as my thesis advisor.